Hi everyone, today let's talk about technology. On my last episode, I was arguing that the QQQs were actually the weakest of the three major indices, with the SPY and the Russell 2000 looking a little bit stronger from a technical perspective than the QQQs. But at the end of the week, we had a big time rally, almost 10% from the lows here, and it doesn't seem to be stopping anytime soon. So let's talk about some of the reasons why the S&P 500 as well as the NASDAQ are rallying pretty aggressively after the Fed's rate hike plan. Then I'll go ahead and talk about some of the stocks that analysts are talking about, specifically in the tech sector. If you like trading stocks and options and making money, definitely like and subscribe. I make videos like this as well as portfolio overviews every single week, so make sure you hit the bell so you don't miss out on any future content. Welcome to the Portfolio Bulletin. Let's get started. As I mentioned, tech rallied pretty aggressively towards the end of the week, and that's partly because, in my opinion, the Fed finally came out with their plan and conducted their first rate hike. They do mention there's still effects here from Ukraine, and we don't know exactly what that looks like yet, but it seems to be calming down at least a little bit. They continue to negotiate, and there's talks of a potential ceasefire that may hold up, but for now it doesn't seem to be too big of a change coming here in the short term. Otherwise, looking at the markets, we had a massive two-day rally for the S&Ps, as well as the QQQs, which almost always pulls up the S&P 500 because tech makes up such a large percentage of that index. I mentioned that the Fed meeting ended up being a non-event because they stuck with their plan, which they had briefed several times, which allowed for some consistency in the markets, and investors always like consistency. They don't want to see anything change, and when there's no changes, it's easier to price in what has been briefed. And based on that, you can see here on the chart, from the lows here at the end of day on March 14th, it basically rallied all the way into the end of the week on Friday. I mentioned here the peace talks that I talked about earlier, and that the market was not concerned even though a spokesperson from the Kremlin mentioned that those peace talks were not accurate, and the Financial Times still briefed that there was significant progress made with a plan for Russian withdrawal from Ukraine. On Thursday, they mentioned that Russia plans to pay with coupons on its sovereign bonds in order to avoid a default, meaning that the government is certainly in a very tough spot in terms of paying for their debt. They're having to pay with coupons. This means that they can only do this for so much longer, and even if they do pull out now, they're definitely in a weaker spot than they were originally. They continue to talk about concerns about how they're going to pay. Are they going to pay in dollars or in rubles? Especially because there's a lot of uncertainty with the value of rubles here in the current market. The debt market has basically cut off Russia, moving them out of the financial system due to its war in Ukraine. It says in order to avoid default, they have to make payments in dollars versus the rapidly weakening ruble. It's unclear if foreign banks would process these payments or allow Russia to access its accounts. All of these happenings led to some deep prices in terms of tech stocks, and they're saying here that these are opportunities that we haven't seen since around the peak of COVID or in 2008. And because of all of these things, you see analysts coming out and saying it's time to start buying up tech. They say Apple is their clear favorite, but all of the FANG names are very strong, and they've endured a heavy declining period so far in 2020 as investors rotated away from high growth in anticipation of higher rates. Another analyst here saying that tech stocks are oversold. It's time to start buying up these names, led by the FANG stocks once again. And basically this trend continues throughout the rest of the article. Tech stocks are oversold, far worse than they should be, and it's time to start buying these stocks. Then they list some of the growth names that have suffered pretty dramatic losses, such as Zoom, which is down at least 34% year to date. Then they show a chart comparing all the FANG stocks to the S&P 500. They're still all outperforming quite a lot since 2016, but you can see companies like Facebook, which dropped off a cliff and is actually now underperforming the S&P 500, and then the pretty large sell-offs across the board with the S&P 500 being pretty stable comparatively. Moving over here to the technical analysis on Tasty Charts, you can see we had that really strong rally over the past 4 days, getting a little bit overextended and coming back and touching the 55 EMA, which you could certainly argue that this is a pretty decent resistance point. And we're getting into that upper level of the ATR bands here also, meaning that we might be a little overextended here. And then we have the 144 EMA here at 362 with the 55 EMA basically right where we are at 352. So we have 352 to 362 in terms of range where I think we're overextended, and I would like to see a retrace back down to maybe 345, 344 would be ideal in terms of a buying opportunity. But there are some decent support levels. You could argue maybe 347 would act as support, potentially as we see this kind of a reversal. This is a nice, strong, impulsive move, so that does indicate generally that we're going to see follow-on rally, and that this could be at least a local bottom here for the next few months. Moving over to TradingView, fairly similar, but they do use slightly different time periods for their candles as well as their averages. So for them, the 55 EMA is currently sitting at 355.89, so a little bit more room to the upside before we see that decent resistance. You could argue that this neckline here is going to be basically at the same level as that, acting as further resistance. You can see really just how dramatic this move was and how it looks pretty overextended. Certainly seems like you could see a retrace back down to the 9 or the 21 EMA, somewhere around 335 here on this one. Looks a little bit more reasonable, but this is pretty impulsive, so I don't know if we'll see that much of a retrace. We might have to be a little bit more aggressive on the entry. This is definitely impulsive and a solid breakout of these levels that we were seeing pretty well respected over the past several months. But you can definitely see the momentum here gaining on the MACD. A little bit easier to see here on TradingView versus Tastyworks. For reference, I also like to look at ARKK as another indicator of where growth is going. And you can see kind of a similar pattern, but not quite the same. Quite a bit weaker in terms of price action. And on the longer term, these are the very bottom levels in terms of support. You can see we did have some reactions there, but it certainly looked weak, and we've recently popped back up above those longer term support levels for ARKK. And you could certainly argue that this is a little bit of a breakout. We did see something like this here in December of 21, so this could certainly be a fake out, but if this does act as support, there's a lot more upside potential here than there is in the QQQs. So if you're looking for a little bit more risk and a little bit more potential for rewards, ARKK might be a little bit better in terms of a longer term investment, as this does still look pretty weak here in the short term. But if you believe in Cathie Wood and some of her decisions that she's made, this could be a longer term, higher potential for reward. And as always, I do want to show my current positions just so you can be clear on what my opinion is in terms of my money. Right now, I'm currently uninvested. That rally was pretty aggressive, and I think we are overextended, at least in the short term. I'm waiting for a little bit of a pullback to re-enter. I've been pretty focused on selling short-term puts, and you can see here, anytime the puts are generally below 1% of the stock price, that tends to be a little bit too cheap for me, and I prefer it to be somewhere between 1 and 2%. And you can see out here to 4 days from now, this is being filmed on a Saturday, so this is the Wednesday expiration for QQQs. You can get about $4 with the current at the money puts for $351, but really I would like that to be somewhere around down here at $344 or $340 and get that same credit level at $4, which would really put my break even somewhere around $340 to $336 over the next few days. Let me know down in the comments section what you think of tech stocks from here. Is this a buying opportunity, and will it continue to rally aggressively up to new highs? Definitely comment down below what you think of the future of tech and what stocks you may or may not be buying. And make sure you hit the bell so you don't miss out on any future content. Of course, none of this is financial advice. This is all for entertainment purposes, and have a great day.